Hello and welcome to the latest episode of the PKF Podcast. Today I'm joined by David Pring, PKF Newcastle and Sydney's tax partner. Thank you, David, for joining us.
Good morning.
Thank you. So today we're going to talk about submitting your tax returns for 2025. So, David, what are the biggest tax law updates in 2025 that business owners should be aware of?
So in terms of tax law update, the biggest changes have actually come through the courts rather than through Parliament. The tax office has had some wins with anti-avoidance, so overturning transactions because they were done for a tax reason, not for a commercial reason. So taxpayers certainly, when they're preparing returns, need to make sure they've got really good support for transactions that they did during the year, particularly restructures or acquisition sales, that sort of thing, where the tax office can and has won in the courts on just general anti-avoidance, which is a bit unusual. The other changes that have happened is the courts have also had some wins on capital versus revenue distinction. So this is where you're selling an asset. And it could be shares in a company, or it could be a property, it could be land and building, and taxpayer thinks that that's on capital account. They've held it for more than 12 months, so they should get capital discount and only get taxed at half their marginal rate. Where a property's been bought with a purpose of resale, tax office can turn and say, no, that's on revenue account. So you bought it to sell, you've now sold it, you made a profit, the whole profit is taxable at your marginal rate. So that's interesting. It's always been the law, but there's been some interesting cases in that area over the last year that show that the tax office is serious about this distinction, and it makes a really big difference. For example, if you bought a house and you lived in that house, but you bought it with intention to resell it, to do it up and resell, and you do resell, you would think that you would get principal place of residence exemption and no tax. However, that's only a capital gains tax exemption, not a revenue distinction. So if you fall into revenue, it's fully taxable, even though it was your house that you lived in. And we had a case this year where a lady moved out of a house, bought a unit in a aged care facility, but she was buying an interim unit to sell, to move into the permanent one when it became available. And even that became taxable on revenue account. So that's an interesting distinction. Another case that we had during the year, which was initially a win for the taxpayer and now has been tax officers won on appeal, is directors of a trustee company and whether they're subject to FBT. And so in this case, the directors had use of cars in the trust. They didn't consider themselves to be employees, so they treated it as subject to the Division 7A loans provisions. Tax officers just won a case to say that should be subject to FBT, so taxable at top marginal rate, even though they weren't drawing a wage. So taxpayers really need to be careful about directors, certainly in the private company scenario, and be mindful that things aren't necessarily as straightforward as they seem. The other change that has also come through the courts in the last year is the treatment of an unpaid present entitlement from a trust. So this is where a trust has distributed profits to a company, quite a common scenario, and the tax office for about the last 15 years has treated that as a loan from the company back to the trust and subject to the Division 7A rules. Well, courts have held that practice statement that they came out with 15 years ago is not right. And so taxpayers operating with trusts and companies really need to make sure that they look at their unpaid entitlements and don't take the tax officer's word for it that it needs to be converted to a loan. So that can change somewhat how taxpayers will treat dividends, loans in the coming tax returns. Don't assume that the way you've always done it is the best way.
That sounds really great, David, and it sounds like there's a lot of things that business owners need to consider coming into the next financial year as well. I guess, David, could you give me an understanding of, for business owners and the upcoming tax season, and what opportunities might be for the reassessment of cash flow and profitability and potential long-term strategies?
Sure. The tax season is a good opportunity to think about the year that you have just been through, and also to think about the year that's coming up. So I always like to look at results for the current year and what businesses are forecasting for the following year. Tax season is that arbitrary cut between now and next year. That gives us an opportunity to assess where we are at a point in time, so balance sheet, and what the past year has looked like from a profit and loss point of view. Profit and loss, by and large, is what drives our tax bills, but it's our tax bills that affect our cash flow. And cash is king in business, and regardless of what your tax expense in your financial statement says or what your tax return says, when you have to pay that tax can make a real difference. So leading up to 30 June, it's a really good opportunity to say, what is our tax bill likely to be for the whole year? What instalments have we already paid over the course of the year? And when might tax be payable going forward? So if you've got a company with 30 June year end, they might have paid instalments for in July, October, February and April. That July instalment relates to the prior year tax, and the instalment for the current year is going to be payable in July this year. So looking at how much tax you have to pay, take off what you have already paid, making sure you get the years right, and then the balance of that is going to be payable probably in December, possibly in February, and that is what often catches people out, is the final payment. You don't want to be paying too much in advance, so you have to get a refund, but you also don't want a surprise down the track. Or if you are going to get a surprise, then it shouldn't be a surprise, even if it's a large number. Knowing about it can take away that issue. So if, for example, you hadn't had a big profit in the year before, but this year you've had a big profit, your cash flow is probably pretty good because you haven't been paying tax. But you're going to have a catch-up in December or February, which is going to be 100% of your tax bill. When you lodge that tax return, you're then going to be paying instalments based on that large tax bill, and they're going to be payable possibly in February, March and July. So you'll have another 3 or 4 instalments coming up in the next year, which will seem like you're paying 100% of your tax bill for the last year and 100% of your tax bill for next year, all within a 4-month period. So cash flow is king in terms of tax. There's also an opportunity to make sure that you're accounting for income and expenses in the right year. So, what's often called tax planning is really only, is there income that we can defer to next year? Are there expenses that we can bring forward to this year? And some of those are just making sure that we deal with the rules correctly, like superannuation, bad debts, employee bonuses. If we're going to spend money in July, maybe we should spend it in June to bring forward that tax deduction. If we've got a transaction where we're looking to sell an asset, maybe we sign that on 1 July rather than 30 June. So to push that out to another income year. There's some things that we can do from a tax point of view that are making sure we optimise position But understanding that cash flow is really key.
I've definitely learnt the understanding between doing the right thing and making sure that you're giving your clients the best opportunity for their business in terms of that long-term strategy as well, but making sure that you're also doing the right thing by the law too. So David, this has been a really, really awesome chat, and thank you for your insights. The final question that I want to ask is, what can business owners be doing now to be making the most of their 2025 tax return, and what can they be considering now to make sure that they're going forward in the right way?
Yeah, so a lot of what needs to happen between now and 30 June is making sure that actions are taken before 30 June that need to be done. So this could be making contributions to superannuation. The money has to be with the super fund for you to get a deduction. You can't say you're making a deduction and make that in July or August. Once 30 June's gone, it's gone. And it needs to arrive in the super fund. So getting those done before 30 June is really, really smart. Bad debts is another one that particularly businesses need to think about. Businesses often provide for debts that they don't think they're going to collect, but in order to get a tax deduction for that bad debt and be able to write it off for tax purposes, the debt needs to be written off as bad before 30 June. So you could think about having a board resolution that identifies the debts and resolves to write them off before 30 June. You could make sure that that happens in the accounts as well. Or you could actually forward the debts to debt collector. Whatever your process is, it needs to happen before 30 June in order for that to happen. So the minimum is a board resolution, which is then written off in the accounts, and you could go further than that and send those debts to collection agency, etc. So that's bad debts, superannuation. What else? In terms of expenses that you're likely to incur, the two things you need to think about is, are there assets that I'm planning to buy that I should buy before 30 June? $20,000, any asset up to $20,000 is deductible in the year it's purchased. So buying something in June is better than buying something in July. Mindful of your cash position. The other one that is really interesting to look at is to make sure that employee bonuses are incurred this year. So by nature, they're not going to be paid until next year because they're going to be based on year-end targets. Making sure that everything necessary for that payment to be made has happened before 30 June. So if the calculation is as part of contract and it's a percentage of sales, then it's going to be able to calculate that formula, and there'll be a debt due at 30 June solely based on the contract. Where there's some element of approval that's necessary that says, percentage of sales subject to approval of the board, then that board approval needs to happen before 30 June. So it's making sure that those expenses that are likely to be in your accounts anyway have had everything done necessary for you to get a tax deduction as well. For those with trusts, trust resolutions by 30 June is absolutely essential. If a trust resolution isn't done by 30 June, then the risk is that the trust is taxable on all of the income of the trust at top marginal rates. So planning where income is going to be distributed to and have a trustee resolution signed to that effect before 30 June is necessary. Now, that's always been the case, but it's becoming more and more possible with technology, etc., for the tax office to look at when that resolution was actually signed. And so making sure that you've got evidence that was signed before 30 June. Yep. If you're having things signed electronically, it's going to be date stamped. So that can be positive or negative. Making sure that you've got it filed on a computer, signed and date stamped would be another way. or emailing it to your accountant before 30 June signed is another way of having evidence that not only was the resolution made, it was in the form and signed prior to 30 June. So those things really need to happen before 30 June. And if 30 June passes on any of those, then you're losing the opportunity to get the best outcome for that year.
David, really great insights and really appreciate your time here today. Business owners, if any of this that you've found really helpful, especially going into the next financial year and seeing what you need to do to prepare now, please get in touch with the team at PKF and David. We're more than happy to answer any questions or help you along the way. So, David, thank you for joining us.
Thanks, Courtney.
Thank you. And thank you, everyone, for joining us on the latest episode of the PKF Podcast.